Okay. Assalamu alaikum. Good afternoon, ladies and gentlemen, and welcome to the DIFC webinar series on UAE development tax. My name is Khadija Ali. I head the business development segment in the DIFC Authority. Our webinar today is in partnership with Ernst & Young, and the speakers are specialists with extensive experience on corporate tax. They will share with us their knowledge about the UAE corporate tax, the key considerations to be taken by different types of entities, including DIFC and other free zones-based entities. Just few housekeeping notes before we get started. The webinar will be around 1 hour and 15 minutes. All attendees' microphones will be muted throughout the webinar. I'm sure that there will be a lot of questions by the audience, so please paste them at the Q&A section, and we will try to address as many as we can at the Q&A session, which we will have after the panel. Since our last corporate tax webinar, the DIFC has announced its 2022 results, and I would like to share with you a few highlights. In 2022, DIFC achieved a record-breaking growth with over 1,000 new registrations and the fastest rate of employment growth with over 36,000 employees working in the financial sector. This is 22% increase year on year. Also, DIFC registered its highest ever revenue, totaling over 1 billion dirham in 2022. Furthermore, the DIFC has topped the global ranking among free zones in attracting foreign direct investments, and this is actually for 5 consecutive years. The DIFC remarkable results reflect the trust that businesses from around the world continue to place in DIFC and Dubai as a financial hub. Free zones like DIFC attract large amount of foreign investments in the UAE. With the UAE corporate tax law coming into force, we can see that the applicability of the UAE corporate tax law to free zones persons has been kept optional. The UAE corporate tax regime builds from best practices globally and incorporates principles that are internationally known and accepted. We will learn in this webinar more about the UAE corporate tax, the applicability, consideration, compliance, requirements, and many other topics. I hope you enjoyed today's session and you find it insightful. With this, I will hand over to Chris. Over to you, Chris.
Thank you, Khadija, and thank you to the DIFC for inviting EY to participate with you in this important initiative and today's session. By way of quick introduction, my name is Chris Lord. I'm a tax partner here in the UAE, where I've been for the last 13 years. And I'm also EY's MENA tax markets leader. I'm delighted to say that I've got a very strong panel of colleagues with me here today to share their thoughts and insights as to the introduction of corporate tax in the UAE and specifically what's important for DIFC companies and structures to be aware of and getting prepared for. Rajan Palmer is our UAE tax market segment leader. We have Mohammed Araji, our MENA financial services tax leader. Daniele Dal Corso, I'm going in order of the seating rather than the slide, is a director in our international tax practice with a focus on wealth and asset management. And Mina Al-Qaderi is a partner in our international tax and transaction services practice. So as a DIFC resident ourselves, we're delighted to be partnering with the DIFC on this important initiative, raising awareness and spreading knowledge about UAE corporate tax. If anyone needs a reminder, the law is out. That arrived in December 2022, and it will come into effect with applicability for accounting periods starting on or after the 1st of June 2023. So really just around the corner, and very important for those companies and people responsible for taxation in the UAE perhaps more broadly, compliance and reporting in the UAE to really get across these developments. So a quick run through of the agenda, which I think really speaks to the fact that the DIFC is much broader than a financial services destination. Lots of other industry sectors represented here, and we'll speak to those through the course of today's session. Professional services, retail, F&B, hospitality, to name just a few. So we'll start with a recap of the corporate tax regime, which Rajan will deliver for us, setting out the key parameters of what's to come. We'll then move on to a sector-specific discussion. Mohammed will cover the banking sector, Daniele, fund and wealth management, and then Mina will speak to the taxation of service providers and what they've got to look forward to. Mina will also speak to timelines and compliance requirements, and we'll be looking to save ample time for Q&A towards the end of the session. So please do use the Q&A function on Zoom, and we'll get through as many questions as possible. And at the end, we'll hand back to Khadija for a wrap up. So I think without further ado, we can move into the first session, and I'll pass over to you, Rajan.
Thanks, Chris, and good afternoon, everyone. Pleasure to be here. I think before we go into the detail or the technical detail, I thought it'd be helpful just to recap on what's sort of driving this development in the UAE as a kind of a starting point. I think what we've seen in international tax landscape in the last decade has been some fundamental change globally, and it's been driven by the G20, the OECD, the bloc of the EU countries, and obviously also the US driving significant change around taxation and principles of taxation around the world. And I think back to Khadija mentioning earlier that the UAE is very much positioning itself as a competitive hub for businesses globally to establish and do business. The UAE is very much part of and staying very close to these developments that are happening around the world, and is also as part of that a member of the BEPS inclusive framework. So we've seen already developments come through the UAE before, such as CBCR, economic substance regulation, FATCA CRS, all things that the UAE has implemented to continue to be a competitive environment in the global standing. And the introduction of corporate income tax is, I think, just the next step in that journey, really. It's also important to be mindful that the UAE has established a very broad treaty network over the years. I think over 100 treaties signed and still more to become effective. And a very important part of that treaty network is around the perception of how tax is being, how income is being taxed on the recipient side of the income in the UAE as well. So we've seen scrutiny around the world in the past around 0% tax regimes and the applicability of treaties to 0% tax jurisdictions. Also, countries obviously less inclined to enter into double tax treaties with countries that have a 0% tax regime. So again, this is all very much enforcing the establishment of the UAE treaty network and the application of its treaty network going forward. I think another very important point, and I will touch on this perhaps later as well, is the global minimum tax proposals. The OECD has been very much focused on this, and that's getting consensus around the world, and we'll see that effectively coming into application from 2024, similar timeline to the corporate income tax regime. So again, that is another reason why the UAE is looking to protect businesses in the UAE from being taxed at a potentially higher rate in other countries it operates in, and collect that tax domestically in the UAE. And often what we'll see, and we've seen happening in other countries around the world, and we're seeing this also through the free zones and the DIFC, is incentives that are being developed around attracting businesses in the context of having a corporate tax regime and then providing non-tax incentives for businesses to establish. And we're seeing that develop more and more in the context of a fiscal policy as well as a wider incentive program. So that's just a bit of, I guess, a backdrop as to what's driving this. I think if we move on to the next slide, Eamon, I think just to sort of set the scene here, and we'll go into a lot more detail, I'm sure, as we go through the sector discussions, but just as a bit of a reminder, so we had a federal decree issued in December, as you mentioned, Chris. I think it's important that we remember it's a federal law. So it's applicable to all Emirates and across all free zones, right? So it's I think similar to the VAT that was introduced in 2018, a federal level taxation, and so everybody's in as a starting point. So see, that's very relevant for companies established in the DIFC. I think it's important to note that it's kind of 60% of the legislation has been released as part of the decree. Roughly, there's still a number of a lot of detail still to come through ministerial decisions over the next 3 to 4 months. So a lot of gaps around certain definitions that we'll see being further clarified, and so that's something that we should obviously be looking at as that legislation comes through. And I think it's also important to note that we've seen concepts in the legislation that are taken from sort of best-in-class regimes around the world. So this is really, a very kind of competitive, I would say, corporate tax system that is really focused on bringing the best sort of concepts globally and bringing them together in a sort of a first-in-class regime. So that's sort of, I guess, the legislative development. I think some of the key parameters around it, we have a 9% headline tax rate. We have a 0% rate as well, and this is particularly relevant for the DIFC as it's applicable to qualifying free zone persons with respect to what is qualifying income, which is, we'll talk about a bit more, but still to be defined. It's applicable to resident and non-resident persons. So there's a concept of tax residency, as we see, in many other countries. There's a lot of exemptions. I would say there's specific targeted exemptions for certain types of exempt persons, but then there's also there's exemptions for certain types of income. So I think that's a very important thing for companies established in the DIFC and more broadly, that can you qualify for any of those specific exemptions will be interesting to look at. It's very much a kind of a simple to operate regime in the sense that it starts from your financial statements on an entity level. You'd make tax adjustments to your income to get to a taxable income, which would then be subject to the rate that's applicable. And I think the final point to make really is that there is a transfer pricing regime also embedded within the corporate tax law, with a requirement to maintain some level of transfer pricing documentation on related party transactions. So that's just a bit of a recap of the key parameters. The effective date is 1 June 2023, or accounting periods beginning on or after that date. So for December year end, we'll be talking 1 January 2024. It is important to note, however, that there is a transitional rule which is already in effect, which we'll also touch on a little bit later in the discussion. So that's just a bit of a opening, I guess, overview, a bit of a flavor. And Chris, I'll hand it back to you.
Thank you, Rajan. Yeah, always useful to be reminded of the policy drivers and also very helpful overview of the key features of the regime that's coming through. Mohammed, we'll jump straight to you and dive into the sector discussion. I think you're going to pick up on banking services.
Yep. Thank you, Chris. Good afternoon, everyone. So as you and Rajan mentioned, and also Khadija earlier, the DIFC is an attractive destination for many investors. And the banking sector at the DIFC doesn't fall any short of that. So there's a wide range of banking services provided out of the DIFC: retail, corporate, investment, M&A, advisory, and private banking. Depending on the license that you have with the DIFC and the type of services that you're authorized to provide, you will have a specific operating model on how you provide services and how you derive your income. And that going forward will be potentially subject or raise some tax implications. So we'll talk about a couple scenarios on what does that mean. And I'd like to highlight that these are just scenarios for illustration. So don't consider these as advice. They might apply to you or not. So before digging into these scenarios, let's talk about the key point, qualifying income and qualifying free zone entity. And that's probably the biggest missing definition in the legislation so far is qualifying income. So to qualify or to be classified as a qualified free zone entity, you have to meet a certain criteria. You have to have adequate substance. You have to follow transfer pricing policies, and you have to maintain relevant transfer pricing documentation. It's worth mentioning that financial services have specific transfer pricing regulations or requirements specific to them. And now more than ever, these are very relevant for you to meet this qualified free zone entity criteria. You need to derive qualified income, the definition that almost everybody on this call is anticipating and waiting for. And then you should have not elected to be treated as fully taxable at the 9%. And of course, in the future, you need to address and meet any future requirements that may be released in a ministerial decision. So this is broadly the criteria to be qualified as a QFZ entity. So let's take a couple examples here. So if you are a branch of a foreign entity, you're operating out of DIFC and you're providing services to head office. And all your revenues is a recharge to head office at an arm's length, through an arm's length mechanism, let's say cost plus 10%. Pending the definition of the qualified income, if that revenue is within the definition viewed as qualified income, you'll be subject to tax at 0%. So this is on one side of the spectrum of services. On the other side, you can be a full-fledged, providing full-fledged banking services through a subsidiary in the DIFC. And then that will potentially give you the revenue or the book of business, the revenue with a mixed portfolio, part that's considered qualified income as per the definition, and another part will be considered non-qualified income if you interact with mainland or outside the free zone within the UAE. So the qualified income will be subject to tax at 0%, while the non-qualified income will be subject to tax at 9%, and you can have the option to elect to be treated as fully taxable. And then for the qualified income, you still have to file a tax return. There's a compliance element, but there's no cash tax to pay. And for the non-qualified income, there's a tax bill at the end that you have to submit to the tax authorities.
And I think Mohammed, you raise a really good point there, because there is some flexibility in the regime, right? So even if you are a qualifying free zone person, you can elect to be outside of the regime and be subject to corporate income tax at a rate of 9%. And there's various reasons why we may see some of our audience here today electing to do that. So perhaps, for instance, to ease some of the administrative requirements of having qualifying income versus non-qualifying income and allocating expenses across the two different income streams. Or for instance, if there's a benefit in relation to treaty access and you want to be subject to tax or elect to be subject to tax at the rate of 9%. And similarly, some of our clients or some of our audience today may want to do a modeling exercise and see what is the ultimate cash tax impact if you are subject to tax and have some foreign tax credits to offset against that income. Or if, for instance, you're subject to tax at a rate of 0% and you don't utilize any of those foreign tax credits. So really, there's a lot of flexibility which we see throughout the law, and that's one of the places.
Thank you, Mina. So a couple more points that banks are focusing on is if you're considered a taxable person, fully taxable person, or you elect to be, there are few more elections that you can select. I'll name one, which is also on everybody's mind, is how do you treat your unrealized gains and losses? So you have the option to elect to tax unrealized gains and losses on a realized basis for relevant to assets and liabilities that are booked or accounted for on a fair market basis. So that's one election that's available to you if you're taxable. Another key point, which is extremely relevant for the banking sector, is the provisions for losses on loans. And this is pretty much on almost on every P&L. So provisions, whether general or specific, needs to be addressed. In principle, you would find that the general provisions are normally added back to taxable income and they're utilized as they realize, while specific provisions are deducted with a potential future reconciling adjustment in a subsequent year. So these are two critical points for banking. Having said this, the provisions has not been clearly addressed in the legislation. So we expect a lot of clarity to come out through the ministerial decisions or through subsequent regulations that the sector is waiting for.
Thanks, Mohammed. Just want to pull in Mina again on one of the other elements on the list there, M&A advisory, clearly an area in which you're very active. Just wanted your thoughts on what's interesting out there for the M&A advisory space. What considerations are there?
Yeah, thanks, Chris. That's a really good point. So we see around us, just sitting here in the DIFC, a very vibrant community, not just focused on the financial services, but like you said, we see a lot of professional advisory firms, one of them being our M&A advisors. So really, we'll touch base on it in more detail, but what some of our M&A advisory community would be wanting to think about is they are subject to tax. They do fall within the general tax regime. So there's no blanket exemption for our advisory services or our service providers who are set up in the free zone. Not like what we will hear later on with Daniele, for instance, on the qualifying investment fund regime, which is a specific exemption. So you do fall within the ambit of corporate tax regime. You are subject to tax at a rate of 9%. What you then need to have a think about is, would you be a qualifying free zone person, as Mohammed mentioned, and then you would think about qualifying income and non-qualifying income. Obviously, we're still waiting to see what qualifying income is defined as under a ministerial decision. But what we may see is that a lot of these professional advisory firms and other service providers, they transact very broadly and have a lot of business across the entire UAE community. So both in mainland and in free zone and internationally. So you may end up in a position where actually a lot of the income will be subject to corporate tax at a rate of 9%, if not all, rather than having the 0 and the 9% applying. And that's when you'll need to have a think about your basic concepts again under the corporate tax regime, which we can cover in further detail when we move on to the service providers.
Yeah. Thanks, Mina.
Thanks. So a couple more points for the banking sector to look at is the opening balance for the tax year. So let's say you're a December year end, on January 1st, you have your opening balances for the first tax year. These should be the same as the closing balances for the financial year. So 2023, if you're a 2024 tax year. And these opening balance should be at an arm's length, especially with related parties transactions, and any adjustments that needs to be done between now and then, or even if it's prescribed to be done in a ministerial decision to come out, should be at arm's length and would be subject to the anti-abuse rules. So this is clearly a critical point to keep in mind, that adjustments need to be in line with the spirit of the legislation. Another topic on foreign banks that have operations in mainland where they're subject to Emirates tax. At the moment, these entities are subject to both federal and Emirates tax, but we understand there's a lot of discussion happening between this group of businesses that fall within this criteria and the tax authority to get more clarity on taxation, whether it's both or one or something will come up. So as you can see, tax now is front and center in the discussion on how you do business and how you provide services and out of where. So I think with the rest, we'll get more sense of that. So
absolutely. Yeah, thank you, Mohammed. That was great. I think we'll move over to Daniele. You can speak to his topic of fund structuring and wealth management. So go ahead.
Oh, thank you, Chris, and good afternoon, everyone. Look, when we look at the wealth and asset management industry and the fund industry, those have been two pillars of the DIFC economy, because there have been two sectors that have been developing and thriving during the years. Rajan and Khadija have already mentioned several times that the design of the corporate tax regime has been looking at best international tax practices in order to enhance what was already good in the environment here. Probably looking at the legislation that has been implemented for the fund industry, we can see clear examples of this tendency, how this resulted in active actions that have been embedded into this legislation. Let's start from an initial key remark, which is looking at the specific subjective exemption that has been granted to qualifying investment funds, something that Mina already recalled in her prior discussion. There are not many subjective exemptions provided into the legislation. Providing an exemption means that effectively you are not subject to corporate taxation on income realized by a person that is entitled to such status. And having the fund industry touched by this measure definitely is a proof that it represents one of the cornerstone sectors that the legislator wanted to boost and protect. Let's have a look at this provision a bit more in detail. What is a qualifying investment fund? There are certain requirements that the law has introduced in order to select funds for eligibility to this regime. There is a regulatory requirement. The fund or its investment manager needs to be regulated. There is a requirement that looks at the investors base and basically expect the fund to be either listed in a recognized exchange, or the fund units need to be made available and marketed to a sufficiently wide spectrum of investors. So diversification of investors is definitely one of the criteria. They have also introduced a sort of anti-abuse provision, mentioning that in order to be eligible for this regime, the fund doesn't need to be set up for pure tax reasons or tax avoidance. Of course, that's quite aligned with international practice. But as we can see, those are requirements that should be quite largely available to funds and collective investment vehicles that are widely marketed. Now, another point we need to focus here is relating to what does it mean to be exempt. Well, as I was mentioning, is an exemption for corporate tax that can even be extended beyond the fund vehicle itself. And can be availed by underlying investment SPVs that the fund fully owns and therefore are controlled by the qualifying investment fund. Does it mean that you don't have to register or file tax returns? Well, this is a point that is still slightly controversial. The legislator didn't take yet a specific stand on that. There is a possibility that registration and tax filing requirements will still be there for exempt persons, although potentially with certain significant simplifications. Again, an aspect that we will need to monitor closely as the legislative process of integration of this corporate tax law goes forward. When looking at other provisions of the legislation that may impact the fund industry, another one that I would also keep in the radar is pertaining to the rules on tax transparency. Why is that? Well, tax transparency rules are rules designed to define the tax status of unincorporated partnerships, so partnerships that do not have a legal personality. And that is very important for funds because most of funds are structured as limited partnerships. Of course, there are also incorporated funds, but the vast majority is structured as an LP. Being a tax transparent vehicle means that you are not subject to tax on your own. You are disregarded essentially for tax purposes, and taxation is levied at level of your partners pro rata the investment share that they hold into the unincorporated partnerships. Now, why this rule is important? Well, it's of course a rule that may simplify a lot of the life of the fund itself because it may not have a tax liability on its own. it's something that can be availed from, especially in instances where you may not be able to have an eligibility for the exemption for qualifying investment fund, as I was mentioning before. But the other very specific trait of this legislation is that this is a flexible regime, meaning the tax transparency rules for unincorporated partnerships are not fixed, meaning there is a base case scenario. The legislation would treat an unincorporated partnership prima facie as tax transparent, but at the same time allows the taxpayer to make an election to be treated as tax opaque. So the taxpayer has the ability to assess what would be the impact of corporate tax on the vehicle, what may be also the advantages of being subject to tax, for example, having more easy access to tax treaties, or avoid issues for the investors above the fund that if we have a fund treated as tax opaque would not be considered as the taxpayers on behalf of the fund. So there are certain aspects that may make the election as palatable. But as I was saying, the most important point is that there is flexibility. The taxpayer has an opportunity to decide its own fate from this perspective. Look, overall, this will likely boost a tendency that we have been already seeing in the past years, the onshorization of funds to the UAE financial free zones and the DIFC in particular. The good trait of this legislation and the alignment with best practices, in my view, may just boost this tendency and enhance the position of the DIFC and its visibility as a globally recognized financial hub.
Thanks, Daniele. And I think you presented quite clearly that we're looking at quite an attractive, competitive regime for investment funds. Rajan, maybe I'll turn to you and ask you, how does the regime look for holding companies? Is there a holding regime that you can speak to?
Yeah, no, thanks, Chris. I think similar to what Daniel is talking about for investment funds, actually, we have a regime for holding companies, and we know that there's many holding companies established in the DIFC. It's a very attractive location to establish a holding company for various reasons, and again, the UAE is very much focused on maintaining and attracting so those activities within the free zones. So what we have is at the starting point is that holding companies are within the remit of corporate income tax, similarly to what we've talked about before. It's a federal law, it applies across the board. So you have the compliance requirements. Actually, that's a good thing, as Daniele talked about, for treaty access, that you are subject to taxation as a starting point. However, what you have within the regime, a couple of key features. One is the participation exemption. And we've seen countries around the world with similar types of exemptions on capital gains and dividend income. So there's some conditions to qualify. There's a 5% holding requirement. There's a 12-month holding requirement. And there's also a requirement that the underlying investments are subject to a minimum level of taxation. So there are some hurdles to get across, but they're very much similar to what you'd see in other established holding regimes. So if you meet the conditions, you'd effectively get an exemption on any capital gains or dividend income coming through those participations. The other key feature is that any dividends flowing through the structure up to the shareholder would also be subject to a 0% withholding tax. Yeah. So effectively, with your holding structure, you can ultimately get to quite a tax neutral position, while still maintaining access to treaty benefits. I think a final point is, often we do see financing also structured through holding companies. And again, any interest payments going out would be subject to a 0% withholding tax. So I think looking at the features of the regime, clearly they've been designed to support the holding structures through the DIFC.
Yeah. Thanks, Rajan. That's great. I think we flip back to Daniele. Got an illustrative example for us to walk through.
Yes, absolutely. Probably, Chris, one last point before the case study that I know it's quite relevant for the DFC in particular, given its specific structures for private wealth holding. Just one word on the foundations regime, actually.
Okay.
This is something that I wanted also to flag. Quite interestingly, the legislation has also touched base on the tax regime of foundations. It has defined foundations quite widely, both as family foundations as well as trusts. So it's not only looking at what, from a legal perspective, qualifies as a foundation, but it has introduced rules that would allow to treat the foundation as a transparent vehicle based on election. So it's a bit of the opposite of what we have seen for an unincorporated partnership. It's an unincorporated partnership, just to recall it, is prima facie seen as transparent, but may elect to be seen as opaque. Family foundation is the other way around. It's prima facie seen as opaque, but may elect to be treated as tax transparent, therefore simplifying the tax analysis at level of the vehicle itself, although triggering a need to assess implications for the beneficiaries of the foundation or trust itself. Again, similar tax analysis as the one that a fund structure setup would require is going to be expected for these type of vehicles. But indeed, again, let me restate, it's important that the system allows flexibility and provides for a simplified system through the tax transparency regime in this situation. And we have here on the screen instead a case study where we tried to depict a typical fund structure that we may see in the DIFC or funds managed from the DIFC. As you can see there, we have mentioned a fund LP, so again, an unincorporated partnership that may be either in the DIFC or located outside of the DIFC. Historically, we have seen many fund structures with a pooling vehicle located in the Cayman Islands, for example, but managed via a management company established in the DIFC. A few points of attention that I wanted to flag here. So we have seen all the goods of the tax regime of the UAE when it comes to fund industry. Now let's look a little bit at the point of attention that, based on what we have seen on the market, will require some level of scrutiny and attention. When we look at offshore fund structures managed from the UAE, probably the two key things that I would focus on relating to the tax residency status of those offshore funds, as it may be impacted by the applicability in the UAE of a place of management principle. So funds, vehicles, especially incorporated, that are managed and controlled, effectively managed from the UAE, may be technically attracted to tax residents in the UAE. That requires, of course, a review of the overall governance of the fund, the investment committee structure, the role of the management company as a discretionary manager or not. There is quite a lot of work that will go into that, but it's definitely one of the points of attention. The second aspect pertains to the recognition of a taxable presence in the UAE outside of the tax residency angle, and in particular as a consequence of the application of rules pertaining to the recognition of permanent establishments in the UAE. Now, the concept of permanent establishment is not limited to a fixed place of business of the non-resident into the UAE, but includes as well the case of an agent permanent establishment, is the case where a foreign person has an agent that negotiates and concludes contract on its behalf in the UAE. Here, the management company may often have certain discretionary rights that may assimilate the manager to an agent of the foreign fund. The legislation has foreseen this risk and actually includes a specific exemption, also another positive item of this legislation, that is called investment management exemption. Quite importantly, the name may be misleading because it's not an exemption for the investment manager, it's actually an exclusion from the application of these permanent establishment rules. In other terms, if the investment manager meets certain conditions, one of which is being a regulated investment manager, having a sufficient independence, having a remuneration set on arm's length terms, others that the ministry may integrate via subsequent cabinet resolutions. So to the extent that those conditions are met, the activities of the investment manager wouldn't trigger a permanent establishment risk for the foreign fund into the UAE. Let me touch base for a couple of minutes on the position of management companies and what we have indicated here as a GPCO, so the general partner of the fund, that normally is also the recipient or maybe the recipient of carried interest payments generated through the funds. Those are two vehicles that are expected to generate an important portion of, well, the key portion profits of fund sponsors, do not have normally a massive equity interest into the fund vehicles. As such, won't potentially have access to objective exemptions such as the participation exemption regime. For those entities, the ability to leverage on the specific incentives for free zones and achieve qualifying free zone person status is going to be probably the critical target to ensure an effective management of their effective tax rate going forward. Otherwise, it may be difficult for those two agents into the structure to leverage effectively their manage effectively their tax cost. Last but not least, an important point on withholding taxation. That's something that we have not discussed yet, but is also a very important feature of the UAE tax regime that boosts it internationally. At present, the non-residents receiving distributions generated from the UAE are not subject to withholding tax or subject to withholding tax at a 0% rate. As such, again, it's a feature that simplifies structuring via the UAE. In this case, for example, will benefit the distributions from a DIFC-based management company or carry vehicle to a sponsor located outside of the UAE.
Yeah. Thank you, Daniele. That was a great overview, and certainly the visual is helpful with all the moving parts there. That was good. Mina, I think we'll move on to you and invite a discussion on broader service providers that are here in the DIFC and the areas of the tax legislation that will be most relevant for them.
Thanks, Chris, and good afternoon, everyone. Hello again. So, yeah, as you touched on earlier, Chris, the DIFC has done a fantastic job of attracting the financial services sector, and we don't just see the financial services set up in the DIFC. We see, like we have here, F&B, we see retail, hospitality, professional services. We ourselves are sitting in the DIFC as a professional services firm. We see tech and tech startups setting up in the DIFC, especially with the innovation hub that the DIFC has set up. And we also see real estate being held, so real estate owners and developers set up in the DIFC. So very broad range of service providers. And these service providers, like I mentioned earlier, will be subject to corporate tax under the general tax regime. There's no specific exemptions for free zone service providers, and we go back to the concept of a qualifying free zone person and qualifying income and non-qualifying income. But one thing is that given service providers have such a broad range of operations, B2B and B2C, within the UAE, mainland and free zone, and also outside of the UAE, we may end up in a position where, like I mentioned earlier, a lot of the income could be subject to tax at a rate of 9%. And that's not uncommon. I mean, when we saw the VAT regime come in a few years ago, we saw that VAT did apply across free zone and mainland entities. So what would our free zone service providers be particularly interested to know with respect to the corporate tax regime? So going back to basics again, so some of our, for instance, real estate community out there, you would be wanting to know whether there will be a concept of tax depreciation. Currently, the law is silent on that, but we know that there could be future tax adjustments stipulated under ministerial decisions, and we do see accounting and tax depreciation in other jurisdictions, Similarly, for our tech and our tech startups, they'll be interested to know if there's going to be amortization for tax purposes, or if tax will just follow accounting, and whether in the future there could be R&D credits, which we again see in other jurisdictions. Also, you'd be very interested in your general expense deductibility rules. If you have financing, your interest deductibility rules, we know that there's a 30% EBITDA rule in place. And obviously transfer pricing. So the law does have extensive transfer pricing rules and documentation requirements. They're based on OECD. So a concept that's probably very familiar to our audience. So you'd have to think about transacting with related parties and making sure those are arm's length. Also, if you have other entities in the UAE, so you want to think about grouping, there's a very helpful grouping regime in the corporate tax law. There's also a regime to offset losses between two entities subject to meeting certain conditions. So there's a lot out there that our service providers can think about. There's a lot of benefits, a lot of assistance in terms of, like I said, grouping and filing requirements. Another thing is we already see in the DIFC non-tax incentives and non-tax attractions to attract the community into the DIFC, which is similar to what Rajan was mentioning earlier. So it's not just tax focused, right? There's great business infrastructure in the DIFC. We know in the Innovation Hub, if you set up in the Innovation Hub, you have access to funding, mentorship, world-class facilities, a very world-class education system, and you're working with like-minded people in the same community in the same sector. So it's also great to see the tax and non-tax side to that as well.
Yeah, that's great. Thanks, Mina. And just to pick up on intellectual property, Daniele, IP structuring is an area you've got a lot of experience in, and internationally, a lot of restructuring that occurs, onshoring being the current trend. What do you see as being the impact of the UAE corporate income tax introduction being on IP structures?
Oh, thank you for the question, Chris, because definitely that is probably one of the main areas of concerns for a number of businesses that historically have been doing so in light of other tax and non-tax developments that were relevant to the UAE, in particular the development of economic substance regulations in offshore locations, the more restrictive attitude of source countries when assessing tax treatment of royalty payments to IP holders based in low substance location and low tax locations. The UAE from this perspective was really well positioned. The DIFC in particular in this instance already had an effective framework that was allowing and disallowing the relocation of relevant people functions pertaining to intellectual property assets, as also a legal framework that supports the protection of those assets. So we had a very good starting point, and that was moving. This was actually the engine behind the move of and onshorization of IP assets in the past years. The CIT regime, I see that as a positive factor in this process. Now, having a corporate tax regime in place, on the one hand, will make life of IP holders in the UAE easier when dealing with foreign tax authorities claiming tax resident and subject to tax status treaty eligibility. That is an important element to basically manage and reduce potentially tax cost at source. At the same time, the regime has been designed in such a way that has specific incentives that are available to licensing businesses. The qualifying free-zone persons regime, for example, is something that may be looked at as a potential way to mitigate tax costs associated to the receipt of royalty income sourced outside the UAE. At the same time, there are a few things to be kept in due attention. Substance is one of those. The issue of substance, we have seen it already in the past when economic substance regulations came out 3 years back, is really a key point of attention of the international tax community. Having adequate functions, assets, personnel linked to the development, exploitation, enhancement, maintenance, protection of IP rights is something that has to go hand in hand with the relocation of an IP asset. You just don't move the legal ownership of an asset, you need to move also the functions associated and supporting the move. And again, having those regulations in place is really an important element that qualifies the UAE, the DIFC in particular, as a very attractive location, because also internationally that boosts tax transparency and again facilitate the life of cross-border businesses operating in this sector.
Thanks, Daniel. Very good. So Mina, I think we're going to come back to you on registration, compliance, reporting requirements that comes along with corporate tax.
Yeah.
And then we'll move to Q&A.
Yeah, sure. So last but definitely not least is, what does it mean from a timeline and compliance requirements? So as Rajan mentioned at the start, the corporate tax law is effective for financial years commencing on or after 1 June 2023. So for those of our audience who do have a 31 December year end, that would be from 1 January 2024. Registrations, so registering for tax, actually we do know that registration will be done through the Amara tax system, and those who have VAT compliance obligations will already be familiar with Amara. So you register through the Amara system. That's actually already open for registration, so opened in January 2023. And there was a very comprehensive document released that had step-by-step guides and screenshots of how to work your way through that registration. We do recommend that our audience doesn't, perhaps rush to register. So just take some time first to really digest some of the material that we've discussed in the law in particular. So with respect to understanding how your legal structure will ultimately look like, whether there's any tax grouping that you would like to avail of and meet the conditions for, whether you're a qualifying free zone person or not. So there's some things that you should consider first before registration, but it's great to see it's already up and available. We also do know that, tax returns, you'll only be required to file one tax return in the tax for that tax period, and that will be due 9 months after your calendar year end. And there are no provisional tax payments or tax filings that you need to do until that period. Also, when you do file your tax return, there is a TP disclosure form that's also due, and you're not required to file any master file or local file at that time. But if it is requested by the FTA, then you will need to be able to show those within 30 days after request. So there's a lot of clarity and guidance out there just to help our audience start planning as well from a compliance and timeline perspective.
Fantastic. Thank you. Thank you, Mina. Good to cover the more practical side of things. That's important.
Yeah, exactly.
Okay, well, I think we'll move to Q&A. There's been a huge amount of questions that have come through the chat. So thank you for everyone who has submitted their questions. Let's start. Mohammed, I'll fire this one to you. This is a point on the 0% rate for rezone companies and the requirement for adequate substance.
Yeah,
I think you mentioned earlier. So what do we know about the definition of adequate substance? How do you satisfy that test?
So a direct definition of adequate substance is not out yet. But if you look around in the UAE, there's the economic substance regime, which is a great benchmark and reference to use.
Yeah.
Now, one thing is that the economic substance regime has a specific purpose and specific requirements. Some of the businesses or the entities in the DIFC might fall outside the ESR, but still want to qualify as a qualified free zone entity. So the question actually is, will more clarifications come to capture those so they can benefit from the qualified free zone entity status or not? But the ESR is actually a great regime to benchmark and reference for the time being.
Yeah. Thank you, Mohammed. Rajan, I'm going to come to you with a pillar 2 question, which is not surprising that this one comes through. What do we know about the UAE's intent to introduce pillar 2 and in what form?
It's a good question. Chris. So just maybe take a quick step back. So the Pillar 2 rules, there's sort of two sets of rules that are being developed by the OECD. One is the GLOBE, which is the minimum tax rules, which effectively apply 15% minimum tax on profits globally. And the other rule is the subject to tax rule, which is effectively a treaty change, which would effectively deny the access to a treaty benefit where the income recipient is not subject to at least a 9% nominal tax rate. So you could taking STTR, the 9% actually corporate tax regime very much aligns with the STTR rate that's required to maintain treaty access. That's going to come through effectively a multilateral instrument that will amend double tax treaties. We've seen that happen in the past. The GLOBE rules, the minimum tax rules, can be introduced through a few different mechanisms. So some countries are looking at the implementation of an income inclusion rule. And some countries are looking at introducing a qualifying domestic minimum tax rule. So the UAE's position specifically is that, well, the UAE has signed the agreement to introduce Pillar 2 as part of the BEPS inclusive framework. It hasn't yet released any legislation. We've understood that there will be a consultation on what the UAE will introduce with respect to Pillar 2. So the anticipation is once we kind of get through the legislation that's still to be released for the corporate income tax regime, probably post June, we may see a consultation period for Pillar 2. And I think also it's clear that the UAE is sort of waiting to see what other countries are doing around their implementation, and will leverage that to determine what is the sort of the best approach for the UAE around its introduction.
Yeah, thank you, Rajan. And maybe just a quick reminder for the audience as well that these rules are only applicable to multinational enterprises that are of a certain size, being 750 million euros and above consolidated revenue. So not applicable to everybody. Going, I guess, to the other end of the scale in terms of businesses, Mina, any relief for small businesses?
Yeah, sure. That is going to the other scale. So good question. Very good question. So we know, so currently under the law, we have a small business relief provision, which says essentially, so it's different from the 0% corporate tax for taxable income up to AED 375,000. So that's different. I just wanted to say that these two work in parallel. One of them is for taxable income, and your first 375,000 is subject to tax at a rate of 0. But we also have the small business relief provision, like you've just asked, Chris. And what that says is that taxable persons who have revenue, so it's different from taxable income, it's your revenue, and that revenue is below a specific threshold. So the law hadn't defined the threshold, but subsequently in the ministerial decision, the threshold was set at 375,000 AED, so similar. If your revenue is below the 375,000 AED threshold, then the taxable person will be treated as deriving exempt income. So essentially, they would be not seen to be having any taxable income. And that's an election that the taxable person can elect into. So you have to make that election. And there are specific conditions for that election. So there could be, for instance, looking back at your prior years to see if in your prior years you had met the 375,000 AED threshold. So there are some conditions the taxpayer has to elect into it, and it's based on revenue. And it is there in the law and as a specific provision to help small businesses.
Yeah, thank you, Mina. Rajan, I'm going to come back to you because there's a few questions here wanting some elaboration on holding company regime and there's participation exemption specifically. If you can give a bit more detail on that. The participation of the exemption requirements.
Yeah,
helpful to run through.
Yeah. Okay. Yeah. No. I alluded to it earlier. I think the primary conditions to qualify for the participation exemption, which again exempts if you have a holding company and it has shareholdings in foreign entities, if it derives dividend income from those subsidiaries, or capital gain income on the sale of those underlying subsidiary shares, then the participation exemption would exempt the dividend income and exempt the capital gains tax on the gain. So that's kind of the outcome. The conditions are that you have to hold the shares for a 12-month period, or at least a 12-month period uninterrupted. So that's the first condition. The second condition is that the participations themselves, so the underlying shareholdings, should be subject in whichever country they're established in at a minimum rate of 9% corporate tax. So if you hold shareholdings in a 0% jurisdiction, then that potentially doesn't qualify. There is a look-through rule. So if you have, for example, tiers of, or if you have a 0% or tax exempt company as your initial, I guess, holding company below your holding company, you could look through that to the underlying subsidiaries, and if those subsidiaries are subject to 9%, you might still qualify. So there is a sort of a look-through rule if you've got a stack of holding companies with respect to that sort of subject to tax rule. And then, the third condition is that you have to have a minimum of 5% shareholding. So if you have less than 5% shareholding, if you derive income, dividend income, or capital gains from a sale of that shareholding, then that would not qualify for participation exemption. So those are the three key conditions to qualify. There's a number of other sort of provisions around the participation exemption. So I think there's a fair bit of other points that you need to work through, but those are the kind of three key criteria to qualify.
Yeah. And as you mentioned earlier, 0% withholding tax on any flows up the chain. Very good. Okay, let's have another question. So you have mentioned that a qualified free zone may elect not to benefit from the 0% tax rate. Would you mind clarifying or elaborating on why a qualified free zone entity would not want to benefit from the 0% rate? I think you already covered that, Nina. Do you want to just go again?
Yeah, of course. So there could be various reasons for a qualifying free zone person to elect not to be subject to tax. And I think, as I mentioned, one of the considerations could be just from an even administrative perspective of actually having to keep record or tracking your qualifying income versus your non-qualifying income, and then also allocating your expenses and amongst the two different income streams. So if from a administrative simplification purpose, that could be one of the reasons. Another reason could be if there's any sort of uncertainty on any tax treaty benefits that you would want to be subject to tax and under the 9% regime, so fully subject to tax rather than qualifying free zone person. And it could be that on a modeling perspective, it may end up being more, more tax efficient or more favorable for a particular business to be electing to be subject to tax. So there could be some considerations there. One thing to highlight is that it is irrevocable, so you wouldn't be able to fall in and out of the regime. So you'd want to be doing some upfront thinking about that before you do elect.
Okay, thank you, Nina. Daniele, foundations, can you elaborate on the taxation of a DIFC foundation and the concept of transparency for the beneficiaries?
Yes, no, thank you, Chris. And we have partially covered that, but just to restate a few important concepts. When you look at a DIFC foundation, that's something that has legal personality. It's a corporate vehicle. It's not like a trust that is a contractual arrangement. So it makes sense that, as the law actually provides, a foundation is prima facie seen as a taxable person. It's a body corporate. Now, the legislation, as I was mentioning, has this particular election that can be made for a foundation to be treated as a tax transparent vehicle. Of course, applying mutatis mutandi the rules of transparency to a foundation require a certain degree of flexibility and interpretation. We don't have partners in a foundation. We have beneficiaries, we have a custodian. So normally the reading of this provision may be tending to recognize a sort of an assimilation of beneficiaries with limited partners. That means if I elect to treat a foundation as transparent, I would then need normally to assess whether the beneficiaries of the foundation, pro rata their beneficial ownership interest into the foundation, may be subject to tax in the UAE. So, of course, that would mean, again, assessing on a standalone basis the position of those beneficiaries. Do they have effectively a taxable presence here? Are they regarded as UAE taxable persons? And effectively determine their liabilities via this look-through approach. Again, it's an ability that the taxpayer has anyway to determine whether it is more convenient to treat that as opaque or transparent. The flexibility that is allowed by the system is definitely a positive item that I'm sure many operators will benefit from.
Thank you. Mina, I'm going to come back to you because there's a few questions around registration requirements, specifically for branches of foreign entities.
Yeah, sure. So the law does say, and I actually have it in front of me, that a taxable person is could be a resident or a non-resident person. And so in this case, I think you're referring to a branch of a non-resident person. So the law then further goes on to say that a non-resident person who has a PE in the state would be considered to be a taxable person. So then we would need to go and think about whether that branch is a PE of the non-resident person. And if it is, then it's seen to be a taxable person. There'll be a corporate tax registration requirement.
Okay, yeah, clear, thank you. Mohammed, there's a few times this comes up actually. Branches of foreign banks subject to tax at the emirate level.
Yep.
Do they still need to pay federal level corporate taxation?
As of today, yes. But we're all waiting for ministerial decisions to come out or a very definitive. It was mentioned in the FAQs, but not as part of the law. So we will see if any ministerial decision specifically to this point will come out. So at the moment, yes.
Got it. Thank you. Daniele, there's a GAR question, tricky one. How does the existence of a GAR impact companies looking to drive efficiencies into their structures?
Well, the existence of AGAR is indeed there to ensure that the introduction of CIT and the effective introduction of the CIT is not jeopardized by reorganizations put forward before the actual implementation of the corporate tax, so before 1st June or 1st Jan, depending on the first financial year impacted. As such, definitely a reorganization put in place today for pure tax reasons is something that will need to be that is expected to be scrutinized, because it's exactly what these rules are expecting to target. It's important that taxpayers undergoing reorganizations to drive efficiencies in the next months will ensure that such process is supported by sound business reasons, commercial reasons, and especially is not only a paperwork that gets put in place, but is something supported by effective changes in the operational model, personnel, etc. Classic example might be the relocation of certain activities to free zones from mainland in order that may effectively lead to efficiencies through the access to qualifying free zone person regime. It will be necessary to ensure that that is really supported by an actual move of the business into the free zone, for example. So definitely something that needs to be reviewed very attentively given the existence of these rules.
Just to clarify, GAR means General Anti-Avoidance Rule, right?
Yes, sorry.
Yeah.
Thank you, Rajan. And I think that's all we've got time for in terms of Q&A. So thank you to all of the panelists for the discussion. And I will hand back to Khadija. Thanks, Khadija.
Thank you so much. It's time to wrap up. I would like to sincerely thank EY team, Chris Lord, Rajan Parmar, Mohamed Araji, Mina Al-Khabairi, Daniel Del Corso, for sharing their insight and knowledge about the UAE corporate tax. With the UAE friendly tax regime, along with the UAE extensive network of double taxation treaties, and the DIFC International Common Law Framework, state-of-art infrastructure, and business-friendly ecosystem, the DIFC will strengthen and cement further its position as a place of choice for business and investment in the region. As the panelists clarified, a qualifying free zone person can benefit from a preferential corporate tax rate of 0% on their qualifying income only. If a qualifying free zone person fails to meet any of the conditions set by the Federal Tax Authority or make an election to be subject to regular corporate tax regime, they will be subject to the standard rate of corporate tax. As the corporate tax law will come into force very soon, it is extremely crucial to emphasize on the importance of early preparation, how you want to structure your group holding. If you are a free zone person, do you want to opt to be subject to regular corporate tax regime to avail certain benefits? There are so many questions which you need to answer. So you would need actually to consult with your advisors and your team in order for you to have tax efficiency and at the same time comply with the corporate tax law. With that, I want to thank all the attendees for attending the webinar and our panelists. And we hope that you have learned and enjoyed the session. Thank you so much.